Welcome to the Deep Dive. We unpack complex reports trying to find those hidden insights. Today, we're diving into a confidential market analysis. It's generating some buzz looking at a real classic asset, gold, specifically its relationship with the US dollar. You'll often see that as XAUUSD in finance.
Yeah, in this report, it gives a really comprehensive view. It pulls together the current landscape for gold, for the dollar, lots of data points synthesized. So our goal today is really to distill the core findings, understand the key forces driving things, and grasp why these details actually matter, especially if you want to be well-informed about global economics.
Absolutely. We're going to try and translate this pretty sophisticated analysis into, let's say, digestible nuggets of knowledge, help you see the bigger picture, maybe even spot some connections, surprising ones that you hadn't considered. So let's jump right in. Explore what's really driving the shiny metal in today's market. Okay, kicking off with the executive summary. This report paints a surprisingly strong bullish picture for gold. What are the main drivers here behind this positive outlook for XAUUSD?
Well, what's fascinating, I think, is how it points to the primary driver.
Yeah.
It's the market's clear anticipation of a Federal Reserve easing cycle.
Right.
Now, this is expected to compress U.S. real yields,
Right.
which, simply put, reduces the real return you get on other safe assets. Think of it like this. If your Treasury bond isn't earning much after inflation, well, holding gold, which doesn't yield anything.
Becomes less costly, relatively speaking.
Exactly. The opportunity cost shrinks. Gold just looks more attractive.
So it's less about right now and more about what the market thinks the Fed is going to do.
Precisely. It's forward-looking. And this fundamental outlook, it gets an extra boost from, well, persistent geopolitical risks and also really robust demand from central banks. That's driven by this de-dollarization trend we keep hearing about.
Dollarization.
These factors together, they essentially create a pretty strong price floor for gold.
Okay, so that's the fundamental side. What about the charts, the technical perspective? Does the price action back this up?
It definitely seems to. The report notes gold is in a clear, multi-year structural uptrend. Higher highs, higher lows. Prices are well above key moving averages, been that way for years. And what's interesting now is the recent action. They call it healthy consolidation.
Healthy consolidation.
Yeah, happening right after hitting new all-time highs.
Yeah.
That often comes before the next big leg up.
What's the bias is bullish?
Unambiguously bullish, according to the technicals here.
All right, let's really dig into the why then. Gold's enduring appeal. The report mentions the real yield environment. It says the current one-year real interest rate is positive, 1.86% as of June 2025. Now, instinctively, you'd think positive real rates. That should be a headwind for gold, shouldn't it?
That's a really good question. It seems counterintuitive, right?
Okay.
Why is gold still attractive? Well, the report clarifies. It's all about the anticipated path, the trajectory. Multiple forecasts see the Fed starting an easing cycle. The Fed funds rate projected to fall quite a bit by end of 2027. Including 2 rate cuts expected later in 2025. So this future compression of real yields, that's what makes gold look good now. Investors are pricing that in already.
Okay, and here's where, for me, it gets really compelling. The inflation hedge idea. The report doesn't just say inflation, it highlights significant stagflationary risk, tariff impacts playing a role too. What does that term stagflationary risk actually mean for us?
Right. Connecting it to the bigger picture, the U.S. economy actually shrank in Q1 2025. But inflation is still stubbornly above the Fed's target.
Still sticky.
Very sticky. May CPI, 2.4% headline, 2.8% core, and the June forecasts, they suggest it might even re-accelerate, partly because of new trade tariffs.
So, okay, the Fed is signaling cuts. They want to support a slowing economy, but inflation's still running hot. That sounds like the classic economic mind, doesn't it?
It absolutely is. And the report nails it, calling it a stagflationary policy mix. It's like the Fed's caught between a rock and a hard place.
Trying to fix two opposite problems.
Exactly. Cutting rates when inflation is high, that basically devalues the currency in real terms. And history shows these kinds of periods very bullish for gold. Because gold is a real asset. Central banks can't just print more gold or devalue it through policy.
Right.
So the demand here, it's not just a simple inflation hedge. It's more sophisticated. It's a hedge against this specific high-impact risk of a policy mistake.
And beyond the pure economics, the report talks about gold as a hedge against geopolitical and systemic risk. It mentions things like the BlackRock geopolitical risk indicator staying high, firms like Eurasia Group talking about a G0 world, like less global leadership. This feels like it's moved beyond just occasional crises, right?
You're absolutely right. It's not just about short-term flare-ups anymore. The report really emphasizes that the nature of this risk has changed. It's become structural, not just event-driven. We're seeing a fundamental fragmentation of that whole post-Cold War global order, the one where the dollar was, king,
Things are shifting.
big time. New trade alliances, different regulations popping up everywhere, technology becoming politicized. This deep systemic change is driving a long-term trend among countries, among sovereign actors, to de-risk and, crucially, de-dollarize. Gold's role here is kind of hedging against the structural decay of that unipolar dollar-centric system. That provides a much stronger, more durable demand source.
And that leads us right into that massive central bank buying. The de-dollarization trend you mentioned. What are the numbers telling us? Because they sound pretty dramatic.
They really are. According to the World Gold Council, central banks were huge net buyers, over 1,000 tons for the third year running in 2024. And it kept going, another 244 tons just in Q1 2025, led by places like Poland, China, Kazakhstan. This isn't random. It looks like a deliberate strategic shift.
Wow, 1,000 tons for 3 years. That's substantial. What does that signal about their confidence long-term in the current global reserve setup?
It signals a really profound shift in thinking, I believe. The 2025 Central Bank Gold Reserve Survey. It's quite telling. A record 43% of the respondents expect their own central bank to buy more gold in the next year.
43%.
Yeah, and get this, 95% expect total global gold reserves to increase, and critically, 73% of these central bankers, they expect the dollar's share of global reserves to fall over the next 5 years.
A clear trend then.
Absolutely. They explicitly link this buying to hedging geopolitical shocks and diversifying away from the U.S. dollar. It confirms de-dollarization is happening, it's well underway.
Okay, we've built a strong case for gold here based on the report. But remember, the pair is XAUUSD. So the other half, the, quote, currency, the U.S. dollar, that's just as critical. What does the report say about the dollar's own path? Let's start with the Fed policy, interest rates.
Sure. So the Fed's kept the target rate at 4.25% to 4.50% since back in December 2024. But the June 2025 FOMC minutes, they were pivotal. The language change. They noted uncertainty about the economic outlook has diminished. Which sounds technical, but it's actually a key dovish signal. It means they're more confident about the path towards lower rates. Most officials now think a rate cut is likely this year. So clear easing bias.
And the markets, how are they reacting to that signal? Are they pricing in cuts?
Yeah, they seem to be. The CME FedWatch tool, which basically tracks market bets on Fed rates, shows a low chance for July, but the odds of a cut by September, around 60%. And the Fed's own dot plot, their internal projections from June, the median participant expects the rate to end 2025 at 3.9%.
Which implies?
2 25 basis point cuts later this year. So yes, the market is definitely anticipating cuts.
Okay, so the Fed's navigating this really tricky landscape. The report also lays out some key U.S. economic indicators in a table. What are the main takeaways there? Is growth slowing down as much as feared?
On growth, yes. The U.S. economy contracted, remember, by minus 0.5% in Q1 2025. Sharper decline than first thought. Now, the Atlanta Fed's GDP Now model forecasts a rebound, maybe 2.6% in Q2. But the underlying trend is clearly one of significant deceleration. It's not a picture of robust growth.
And inflation, is it finally cooling? Or is it still, the main battle?
Well, the hope was for cooling, but the report suggests otherwise. It's stubbornly high. Core PCE, the Fed's preferred measure, 2.6% in May. Core CPI, 2.8%. Both still well above that 2% target.
Still sticky.
Very sticky. And crucially, the Producer Price Index, PPI, which can sometimes lead consumer prices, that's showing rising pipeline pressures too, up 2.6% year over year in May. So this isn't just some inflation. It feels like a persistent issue they haven't quite cracked.
What about jobs? The labor market, that's often seen as the main pillar of strength for the U.S. economy, still holding up.
It is the main pillar, you're right, but it's definitely showing clear signs of cooling down. June Moner, non-farm payrolls, added 147,000 jobs. Okay, that beat the consensus estimate slightly, but it fits with the slowing trend over the last 12 months. And the unemployment rate ticked up to 4.1%. Wage growth moderated a bit to 3.7% annually.
So not falling apart, but losing steam.
Exactly. The momentum is clearly fading.
Okay, finally, the report points to some pretty important structural factors impacting the dollar. What should we know about those?
Right. These are the longer-term issues. U.S. government debt to GDP reached 120.9% in Q1 2025. And it's projected to climb higher, maybe 124.4% by year-end.
Wow.
Now, that's not just a number. The report says this creates long-term vulnerability for the dollar. and it raises serious concerns about something called fiscal dominance.
Fiscal dominance.
Yeah.
What's that essentially?
Think of it as the government's huge debt potentially handcuffing the Fed. If the Fed raises rates aggressively to fight inflation, it makes the government's borrowing costs skyrocket, creates a massive dilemma.
So the debt limits the Fed's options.
Potentially, yes.
Yeah.
Also, the U.S. current account deficit that tracks money flows in and out, it widened a lot, by 44.3% to $450.2 billion in Q1 2025. That represents a large, ongoing structural outflow of dollars, another headwind.
Okay, so after looking at both sides, gold and the dollar, what does it mean when we put them head to head? What's the core tension or synergy the report identifies?
Well, the report synthesizes that interest rate differential piece in a really critical way. Yes, current U.S. real rates might give the dollar a slight edge on paper today, but the market, as we've discussed, is laser-focused on the future path, the trajectory.
What's coming next?
Exactly. That clear signal from the Fed about easing means that very interest rate advantage is expected to flip against the dollar. This anticipated compression in real yields, that's seen as the dominant fundamental force here.
So, given all that, the report's conclusion on which asset, gold or the dollar, has the stronger macroeconomic case. It seems pretty definitive, doesn't it?
It really does. The report states quite clearly that the fundamental backdrop for the U.S. dollar is, well, deteriorating. You've got slowing growth pushing the Fed towards easing, even with sticky inflation. Add in the massive public debt, the widening current account deficit.
Not a great mix for the dollar.
Not fundamentally, no. In stark contrast, gold's drivers are strengthening. It benefits from the expectation of lower real yields. Its appeal as that sophisticated hedge against stagflation and systemic risk is growing. And then you have that powerful structural demand from central banks. So the conclusion is unambiguous. Gold, XAU, has the unequivocally stronger macroeconomic backdrop right now.
Okay, let's switch to the technical side again. What do the charts actually look like? Does the visual evidence tell the same bullish story for gold?
The charts definitely seem to reinforce that view, yeah. Looking across time frames, the long-term trend on the weekly chart, strongly positive. Prices consistently above moving averages, higher highs, higher lows for years. The daily chart confirms that too, a firmly bullish intermediate trend. And what's insightful, as we touched on, is how they describe the recent price action. Healthy consolidation.
A pause after the big run-up.
Exactly. Following those new all-time highs suggests it's building energy for the next move up, rather than topping out.
And any shorter-term patterns, things traders might be watching closely.
Yeah, on the 4-hour chart, the short-term trend is consolidating, but it shows clear bullish characteristics. It's forming a large symmetrical triangle. That's a classic pattern, suggesting the prior uptrend is likely to continue.
A continuation pattern.
Right. And the report even brings in Elliott wave analysis. Those may be less familiar. It's a technique looking for recurring wave patterns in market psychology. And in gold's case, it suggests this recent pullback was just a corrective wave, a temporary dip. And now, a new impulse wave higher, a stronger upward move, is potentially starting.
Are there specific price levels, zones, or indicators that the report flags as critical?
Absolutely. Key resistance is highlighted around $3,400 to $3,405. That's very near the recent all-time highs. Support zones are pegged around $33,345, and then a major support level at $3,280, $3,300. Notably, that major support area includes the bottom of that Elliott wave correction pattern.
Okay. And indicators, moving averages, RSI, and MACD.
Yeah, the alignment of the main moving averages 50, 100, 200 period on the daily and weekly charts, decisively bullish. The daily RSI, measuring momentum, is around 54, so neutral to bullish. It has room to climb before looking overbought. And the daily MACD, another momentum indicator, is showing a bullish crossover, or it's near the zero line, signaling momentum is shifting back upwards.
Okay, fundamentals strong, technicals look bullish. What about sentiment? How is the herd positioned? What does the report say there?
Right, sentiment. The report looks at the commitment of traders, or COT report. That's a great snapshot of how different players are positioned in futures markets. And it shows that the non-commercials, think large speculators, hedge funds, they're actively adding to their bullish gold bets.
They're buying in.
They are. For the week ending July 11th, 2025, their net long position increased to 203,000 contracts. That's seen as strong confirmation of the underlying bullish trend because this group often follows the momentum.
Now, here's something I find really interesting. The report addresses the broader market mood. The S&P 500 is near all-time highs. The VIX index, the fear gauge, is pretty low, around 16.40. That signals a general risk-on environment, right? It doesn't gold, the safe haven, usually struggle when everyone's chasing risk.
That's a really crucial point, and it kind of challenges the simple narrative. Typically, yes, a risk-on mood would be a headwind for gold. People sell safety to buy riskier assets. But the report highlights that gold is also in a powerful uptrend at the same time, this simultaneous strength. It implies that gold's drivers now are deeper than just simple short-term risk aversion.
So it's not just a risk-off trade anymore?
Exactly. Demand for gold seems to be driven by factors that can actually coexist with, or even be amplified by, conditions that are also boosting stocks. Things like anticipating lower real yields, that strategic hedge against long-term currency issues, and that powerful, non-cyclical buying from central banks. It makes this current gold rally feel fundamentally more robust, perhaps less dependent on immediate fear.
So pulling it all together then, fundamentals, technicals, sentiment. What's the report's final conviction level on this gold thesis? How confident are they?
Well, the report points to a really powerful confluence. All three pillars, fundamental, technical, sentiment, they're aligning, all pointing towards a bullish directional bias. They actually give it a high conviction score, 4.7 out of 5. Very high. And the dominant driver, they reemphasize, is unequivocally fundamental. It's the market pricing in that Fed easing cycle and the resulting squeeze on U.S. real yields.
Okay. And finally, no analysis is complete without looking at what could derail the thesis. What are the key risks the report flags? What could challenge this bullish outlook for gold?
Right, the risks. They identify three main ones. First, a hawkish Fed surprise. Imagine an unexpectedly high inflation number, maybe in that upcoming CPI report on July 15th. That could force the Fed to backtrack, delay easing. You'd likely see real yields spike, and gold could see a sharp correction.
Okay, so an inflation shock.
Second, an acute U.S. dollar safe haven bid. Now, we talked about the structural trend being away from the dollar, but a sudden, really severe geopolitical crisis or a financial shock, that could still trigger a mad dash for liquidity, temporarily boosting the dollar and hitting XAUUSD.
A short-term panic flight to the dollar.
Potentially. And third, a technical breakdown, purely on the charts. If gold fails to hold that major support zone we mentioned, around $300 and $280, $3,300, and breaks decisively below, say, $3,275, that would signal a deeper correction is likely underway and would definitely warrant a reassessment of the bullish technical picture.
What a deep dive. Really fascinating to see how all these threads, Fed expectations, geopolitics, central bank strategy, inflation worries, market sentiment, how they all weave together to shape the outlook for gold and the dollar. It really paints a picture of the tightrope central banks are walking, doesn't it? And these profound shifts happening globally.
Indeed it does. This report really underscores how many complex forces are interacting right now, and how gold's role seems to be evolving. It's viewed less as just a temporary crisis hedge and more as a strategic store of value in what feels like a changing global economic order. It's not just about inflation or rates anymore. It feels like a more fundamental reevaluation of how wealth is perceived and held around the world.
So what does this all mean for you listening in? Maybe consider how these interconnected factors, interest rate paths, geopolitical fragmentation, central bank moves, how they might continue to reshape finance globally. Does the idea of an asset, a form of money that can't be devalued by policy decisions, does that become even more compelling as this global landscape keeps shifting? Something to perhaps ponder on your next walk.